Why recovery matters more than the crash. Every economic crisis eventually ends. The Great Depression, the Asian financial crisis, the 2008 global meltdown, and the COVID-19 pandemic all brought devastation to millions of lives. Yet each of these catastrophic events was followed by something remarkable: recovery. Economies rebuilt themselves, jobs returned, and prosperity gradually emerged from the wreckage. The crash makes headlines, but the recovery determines the future. How quickly a nation bounces back, how completely it heals, and what permanent changes emerge from the crisis depend entirely on what happens after the bottom is reached. Some recoveries take a decade, while others unfold in mere months. Some leave economies stronger than before, while others create lasting scars that persist for generations. Throughout modern economic history, recoveries have followed a surprisingly consistent pattern. 5 distinct stages appear across every major crisis. From the banking panics of the 19th century to the pandemic recession of 2020, understanding these stages provides more than academic insight. It offers a roadmap for navigating future downturns and recognizing where any economy stands on the path from collapse to renewal. This documentary examines those 5 stages through the lens of history and the evidence of what actually works. Stage 1: crisis, containment, and emergency action. When an economy begins to collapse, the first priority is stopping the bleeding. Governments and central banks must act with speed and decisiveness to prevent a bad situation from becoming a catastrophe. This initial stage of recovery is not about growth or rebuilding. It is purely about survival and preventing total systemic failure. The tools deployed during crisis containment have evolved significantly over the past century. During the Great Depression, policymakers lacked both the experience and the institutional frameworks to respond effectively. The Federal Reserve allowed the money supply to contract by nearly 30% between 1929 and 1933, a catastrophic error that deepened and prolonged the downturn. Roughly 7,000 banks failed during this period because no mechanism existed to restore confidence or provide emergency liquidity. Modern crisis response looks dramatically different. When Lehman Brothers collapsed in September 2008, the Federal Reserve moved within days to prevent further institutional failures. Congress authorized the Troubled Asset Relief Program with an initial allocation of $700 billion to stabilize the financial system. The Federal Reserve slashed interest rates to nearly zero by December 2008 and began purchasing mortgage-backed securities and treasury bonds to inject liquidity into frozen credit markets. The COVID-19 pandemic triggered an even faster response. Within 3 weeks of the World Health Organization declaring a global pandemic, Congress passed the CARES Act, a $2.2 trillion stimulus package representing the largest emergency economic intervention in American history. The Federal Reserve announced approximately $700 billion in new asset purchases and cut interest rates to zero in a single emergency meeting. Speed matters enormously during this first stage. Research from the International Monetary and CUF shows that countries implementing swift and aggressive containment measures experience shorter recessions and stronger recoveries. Delays in action allow panic to spread, credit markets to seize, and unemployment to accelerate beyond levels that might otherwise have been prevented. The lessons from history are unambiguous on this point. Central banks must provide liquidity without hesitation when financial systems freeze. Governments must deploy fiscal resources to prevent cascading business failures and mass unemployment. Half measures and delayed responses cost far more in the long run than bold early action. The Great Depression taught this lesson through tragedy, and policymakers in 2008 and 2020 applied it with considerable success, containing crises that could have rivaled or exceeded the devastation of the 1930s. Stage 2. Stabilization and confidence building. Once the immediate crisis has been contained, the economy enters a critical transitional phase. The free fall has stopped, but growth has not yet returned. This second stage focuses on stabilizing financial institutions, restoring public confidence, and creating the conditions necessary for recovery to begin. Without successful stabilization, economies can remain trapped in stagnation for years. Confidence is the invisible engine of any economy. When businesses believe customers will return, they maintain payrolls and continue operations. When consumers trust that their jobs are secure, they continue spending rather than hoarding cash. When banks believe borrowers will repay loans, they extend credit to fuel investment and consumption. Restoring this web of mutual confidence after a crisis requires deliberate and sustained effort from both governments and central banks. The Federal Reserve deployed unprecedented tools during the stabilization phase following the 2008 crisis. Between 2008 and 2014, 3 rounds of quantitative easing pushed the central bank's asset holdings from roughly $900 billion to approximately $4.5 trillion. These massive purchases of Treasury securities and mortgage-backed securities drove down long-term interest rates and flooded the financial system with liquidity. The goal was not simply to rescue failing institutions, but to convince markets that credit would remain available and affordable. Regulatory reform also plays a vital role during stabilization. Following the 2008 crisis, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010, fundamentally restructuring financial oversight in the United States. After the 1997 Asian financial crisis, affected nations implemented sweeping reforms to their banking sectors under guidance from the International Monetary Fund. Weak banks were closed or merged, capital requirements were strengthened, and supervision was dramatically improved. The duration of the stabilization phase varies considerably across different crises. Following the 2008 recession, economic weakness persisted for years, with growth averaging only about 2% during the first 4 years of recovery. Unemployment remained elevated well after GDP began expanding again. By contrast, the COVID-19 stabilization phase moved remarkably quickly. Aided by vaccines, pent-up consumer demand, and the sheer scale of fiscal support. Successful stabilization creates a foundation for genuine recovery. Financial institutions regain health, credit begins flowing again, and the public gradually shifts from fear toward cautious optimism. Only when this foundation is solid can the economy advance to the next stage of actual growth and expansion. Stage 3, early recovery. In green shoots, the first signs of genuine recovery often appear tentatively. Like new growth emerging after a harsh winter, economists and journalists frequently call these early indicators green shoots. Small but meaningful signals that the worst has passed and expansion is beginning. This third stage marks the transition from mere survival to actual economic improvement, though the progress often feels fragile and uneven. Early recovery typically manifests in specific sectors before spreading throughout the broader economy. Manufacturing orders begin to increase as businesses rebuild depleted inventories. Consumer spending ticks upward as households feel marginally more secure about their financial futures. Credit markets thaw as banks gradually resume lending to credit-worthy borrowers. Each of these developments reinforces the others, creating a positive feedback loop that slowly builds momentum. The labor market usually lags behind other indicators during this stage. Businesses remain cautious about hiring after experiencing the trauma of layoffs and uncertainty. They prefer to increase hours for existing workers or rely on temporary staff before committing to permanent positions. Following the 2008 recession, unemployment remained above 8% for more than 3 years, even as GDP growth had technically resumed. The COVID-19 recovery proved exceptional in this regard. With unemployment falling from 14.7% in April 2022, 6.7% by December of the same year. Government policy during early recovery often shifts from emergency measures toward growth promotion. Central banks typically maintain accommodative monetary policy, keeping interest rates low to encourage borrowing and investment. Fiscal policy may transition from crisis relief toward infrastructure spending, job training programs, and other investments designed to strengthen long-term productive capacity. The American Recovery and Reinvestment Act of 2009 allocated over $800 billion toward infrastructure, education, energy, and tax relief in an effort to accelerate the recovery from the Great Recession. Psychological factors matter enormously during this fragile stage. Consumer and business confidence surveys often prove more predictive of near-term economic performance than traditional metrics like GDP or industrial production. When people believe conditions are improving, they act in ways that make improvement more likely. They spend rather than save, invest rather than hoard, and hire rather than wait. This self-reinforcing optimism can accelerate the transition from early recovery into sustained expansion, which represents the fourth stage of economic rebuilding. Stage 4. Sustained expansion and reform. Early recovery eventually builds enough momentum to carry the economy into its longest and most productive phase. Sustained expansion represents the period when growth becomes self-reinforcing, employment returns to healthy levels, and policymakers shift their attention from crisis management toward building a more resilient economic system. This fourth stage can last for years or even decades when conditions align favorably. The United States has experienced remarkably long expansions in recent history. The recovery that began in June 2009 following the Great Recession continued for 128 consecutive months, making it the longest economic expansion ever recorded in American history. This growth finally ended in February 2020 when the pandemic triggered a sudden and severe contraction. The previous record holder was the expansion of the 1990s, which lasted 120 months and coincided with the technology boom and rising productivity gains. Sustained expansion creates the political and economic space for meaningful structural reform. During periods of growth, governments possess greater capacity to address weaknesses exposed by the preceding crisis without triggering immediate hardship. The regulatory reforms implemented after 2008, including strengthened capital requirements for banks and enhanced consumer protections, emerged during the expansion phase when the financial system had stabilized sufficiently to absorb new compliance burdens. Monetary authorities face delicate decisions during sustained expansion. They must gradually normalize policy by raising interest rates and reducing balance sheet holdings accumulated during the crisis response. Moving too quickly risks choking off growth before the recovery becomes fully entrenched. Moving too slowly risks fueling inflation or creating asset bubbles that plant the seeds of the next crisis. Rate increases began in December 2015, more than 6 years after the recession officially ended, and proceeded cautiously with small incremental adjustments over the following years. Not everyone benefits equally from sustained expansion. The gains from growth often flow disproportionately toward those who own assets and possess advanced skills, while workers in declining industries or disadvantaged regions may see little improvement in their circumstances. Addressing these distributional concerns represents one of the central challenges of the expansion phase. Policies that broaden participation in economic growth through education, training, and targeted regional investment help ensure that recovery reaches all segments of society and builds political support for continued stability. Stage 5, the new normal and long-term resilience economies never return to exactly where they started. After the turbulence of crisis and the long climb back to health, a transformed landscape emerges. Industries that seemed permanent have vanished while entirely new sectors take their place. Work habits, consumer preferences, and institutional structures all bear the imprint of what came before. This fifth and final stage is not about restoration, but about adaptation to a fundamentally altered reality. The decade following the 1930s collapse reshaped American capitalism in ways that persist today. Deposit insurance, unemployment benefits, and securities regulation all emerged from that era. The International Monetary Fund and World Bank were established to prevent future breakdowns in global finance. These bodies represented more than temporary fixes. They became permanent features of the economic architecture, designed to make future downturns less likely and less severe. Similar transformations followed the 1997 turmoil in Asia. Thailand balanced its budget and repaid international loans for years ahead of schedule. Poverty rates across the region fell dramatically as governments implemented stronger oversight of their banking sectors. The painful lessons of currency collapse translated into lasting changes that made these economies far more resistant to external shocks. Remote work offers a striking example from the most recent downturn. What began as an emergency measure became a permanent feature of professional life for millions of workers. Business formations surged as entrepreneurs launched ventures at rates nearly 50% higher than 1919. Supply chains that once stretched across continents began relocating closer to end consumers, prioritizing durability over pure efficiency. Psychological adjustment often takes longer than statistical healing. Surveys conducted 5 years after 2008 revealed that most Americans still viewed banks and markets as fundamentally insecure. Sentiment can remain depressed even when employment and income have fully bounced back. Rebuilding trust in institutions and optimism about what lies ahead requires consistent stability over extended periods. The ultimate measure of successful rebuilding is not merely reaching previous output levels, but emerging better prepared for inevitable future disruptions. Nations that implement meaningful changes during this process develop economic immune systems capable of withstanding subsequent shocks. Those that simply patch over weaknesses find themselves vulnerable when the next downturn arrives. History demonstrates repeatedly that economies possess remarkable capacity for renewal, provided they absorb the lessons embedded in each painful episode. The Great Depression case study. The Great Depression remains the defining economic catastrophe of the 20th century. Between 1929 and 1933, American output collapsed by nearly one-third. Roughly 7,000 banks shuttered their doors, and unemployment reached a staggering 25%. Yet within 4 years of hitting bottom, the nation had entered one of the most vigorous expansions in its history, with real GDP growing at an average annual rate of 9% from 1933 to 1937. What sparked this remarkable turnaround? The answer lies in a dramatic shift in policy direction. When Franklin Roosevelt took office in March 1933, he immediately declared a national bank holiday, closing every bank in the country to halt the panic. Congress passed the Emergency Banking Act within days, providing a framework for reopening sound institutions while permanently closing insolvent ones. Depositors who had stuffed cash under mattresses began returning their money to banks they now believed would survive. Monetary policy underwent an equally dramatic transformation. The United States abandoned the gold standard, freeing policymakers to expand the money supply without constraint. Currency in circulation grew by 42% between 1933 and 1937, reversing the devastating contraction of the preceding years. Lower interest rates and abundant credit fueled business investment and consumer spending. Fiscal intervention provided additional momentum. The Works Progress Administration employed millions of jobless Americans on public projects, injecting wages directly into local economies. The Civilian Conservation Corps put young men to work on environmental projects across the nation. These programs did more than provide relief. They restored dignity and purchasing power to households that had lost both. The Depression also produced enduring institutional legacies. The Securities and Exchange Commission brought transparency to stock markets. The Federal Deposit Insurance Corporation guaranteed bank deposits, eliminating the rationale for bank runs. These structures remain intact nearly a century later. Fast versus slow recoveries? It's not necessary for all the recoveries to move at the same pace. Some nations return to health within months, while others languish for a decade or longer. The difference lies not in luck, but in the timing, scale, and coordination of the response. History offers clear patterns, distinguishing rapid healers from prolonged sufferers. Speed of intervention matters more than almost any other factor. Countries that act within weeks of a downturn consistently outperform those that hesitate. Delayed responses allow joblessness to become entrenched, businesses to permanently close, and buyer psychology to shift toward prolonged caution. Japan's stagnation throughout the 1990s stemmed partly from policymakers waiting years before addressing underlying weaknesses in their banking sector. The scale of action must match the severity of the shock. Modest measures during severe contractions merely slow the bleeding without stopping it. Nations that deployed massive force in 2020 experienced far sharper rebounds than those that rationed their response. Underspending during a collapse often costs more in the long run through lost output, diminished tax revenues, and expanded safety net obligations. Coordination between monetary and fiscal authorities amplifies effectiveness. When those controlling interest rates act in unison with government spending programs, the combined impact exceeds what either could achieve alone. Disjointed responses where one institution tightens while another loosens produce muddled outcomes and extended weakness. Structural flexibility also determines healing speed. Economies with rigid labor markets, excessive regulation, or concentrated industries adapt slowly to changed circumstances. Those allowing rapid reallocation of workers and capital toward growing sectors mend faster. Ability to pivot distinguishes economies that emerge stronger from those that merely survive. Finally, public faith accelerates everything. Citizens who believe their leaders are acting competently spend and invest sooner, creating the demand that pulls economies forward. COVID-19, the fastest turnaround. The 2020 shutdown produced the sharpest economic collapse in recorded history. Within weeks of authorities declaring a global health emergency, Entire industries went dark. Airlines grounded fleets, restaurants locked their doors, and factories fell silent across every continent. GDP plunged by 31.2% in the second quarter, the steepest quarterly drop ever, documented in American records. Yet the snapback proved equally extraordinary. What conventional wisdom suggested might take years unfolded in mere months. By the final quarter of 2020, output had nearly returned to its previous peak. Joblessness fell from its April peak to half that level by December, a pace of labor market improvement without precedent in post-war data. Several factors explain this anomaly. The nature of the shock differed fundamentally from typical downturns. Factories remained intact, supply networks survived, and worker skills stayed current. Once restrictions lifted, productive capacity could resume almost immediately rather than requiring years of rebuilding. The sheer magnitude of government support also played a decisive role. Direct payments landed in household bank accounts within weeks. Enhanced benefits replaced lost wages for millions. Forgivable loans kept small businesses afloat and workers attached to their employers. This historic transfer of public resources prevented the cascading bankruptcies and permanent job destruction that typically accompanies severe contractions. Vaccine development proceeded at remarkable speed, compressing what normally takes a decade into 11 months. Each successful trial boosted market sentiment and household willingness to resume normal activities. Science provided something no policy tool could: a visible path toward ending the underlying threat. The 2020 episode challenged long-standing assumptions about how quickly economies can restore themselves. It demonstrated that targeted, massive, and rapid intervention can compress years of suffering into months. Universal lessons: economic catastrophes follow no single script, yet recoveries reveal consistent patterns across eras and continents. The 5 stages examined throughout this documentary appear whether the trigger is a banking panic, currency collapse, or global health emergency. Recognizing these stages offers more than academic understanding. It provides a framework for anticipating what comes next during turbulent times. Several principles emerge from the historical record. Swift and bold action outperforms cautious incrementalism when economies falter. The scale of intervention must match the severity of the shock. Those controlling money supply and government budgets achieve far more working in concert than operating at cross purposes. Structural changes implemented during rebuilding create lasting protection against future shocks. Perhaps most importantly, patience matters. Labor markets lag behind other indicators. Public sentiment takes even longer to shift. Leaders who declare victory prematurely risk undermining fragile progress, while those who maintain support through the full arc of restoration position their economies for durable prosperity. Economies possess remarkable ability to renew when given appropriate support. The Great Depression eventually gave way to notable expansion. The 2008 collapse produced the longest, sustained growth period in American history. The 2020 shutdown became the fastest turnaround ever recorded. History teaches that dawn follows even the darkest economic night.